Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And welcome back. Like the man said, if you want to contact me, just go to my website, bullingtoncapital.com. This week sometime we'll get the seminar page updated with the new seminar that's going to be on the 18th of January. So I can't, actually what's kind of funny is they've changed the format of the website. And you can actually sign up for it right now. It's just a little more complicated than it used to be. I don't know why all these web providers keep changing the way they do things. This doesn't look like it's actually an improvement, by the way. But anyway, that's beyond my control. So the official new page for the seminar will be next week. But you can go there now. The old one is still up there, but when you click on register, it takes you to the new description. And this is what we're going to be talking about. So this is January 18th. You can actually sign up now. It's confusing because you go to the website and the old description's up there, and then you click on register and it brings you to the new one. So anyway, it says what we're doing is we're talking about the opportunities and risks coming up in 2018. It's almost here. Hard to believe. It's already the 2nd of December. So I've only got 4 weeks left. By the way, last few years, this last 4 weeks has been pretty good for stocks. It's been very good for stocks. Last January was actually the worst January in the history of the market. So, but it bounced right back, which is eventually what they do. Stocks come back. They fluctuate a lot, which scares a lot of people. But I'm here to tell you, don't get scared. There's nothing to be afraid of. There's absolutely nothing to be afraid of. In worrying about the things that might happen, that's I really feel like it's not a good use of your energy. I just leave it at that. Anyway, so the description is it's different this time, and we all heard that before, right? It's different this time, and it's always different. By the way, it's never exactly the same. But having said that, exchange traded funds. When I left the brokerage community to start my own firm, one of the reasons was I wanted to use the new exchange-traded funds that were coming out. And if you go back and listen to my old radio shows, I laugh about that all the time. That was back when Ed Flash Farron and I were doing it together. And I was talking about this development and how it was going to help the investment management business. And sure enough, the fastest-growing sector of financial services, exchange-traded funds. What I didn't anticipate is how wildly popular they would be and how big of an impact they were going to have on the stock market, in addition to the fact that the number of available stocks for people to invest in has been reduced fairly significantly over the same time period. So you've got more funds investing in fewer stocks, and it's had an impact. Actually, it's changed the way that the stock market behaves on a fundamental basis. It's literally changed the way that stocks behave. And if you're unfamiliar with ETFs, by the way, it's short for exchange traded fund. It's short for exchange traded fund. That's what an ETF is. Whenever you hear that term, that's what we're talking about. An exchange traded fund is a fund that's typically run by a set of rules that are published in the fund's prospectus. They'll tell you how they're going to manage the money. And that's one of the things I liked about ETFs is that they were transparent. You know what you're going to get when you invest in an ETF. You don't know what it's going to do, but you know what you're buying. As opposed to a regular mutual fund where you can't really see the holdings, in a mutual fund, they only have to report that a couple times a year, what their holdings are. And they've got this whole process called window dressing. We won't even bother talking about that. I could do a whole show on that. But with a regular mutual fund, you really don't have that good of an idea of what the manager is going to be doing with the money. That you have an idea of what what they say they're going to try to do. But if the mutual fund manager is smart, and a lot of them are, they give themselves a lot of latitude so they can change on a dime if they feel like they would like to. So realistically, you just don't know what you own. In an exchange-traded fund, there's a description of exactly what you're going to own. It allows you to do a much better job of diversifying, a much better job. So, and they've been so popular that it's been the fastest growing component of the financial services industry. And because of that popularity, there's been some changes in the way that stock prices move. There have been changes in the way that stock prices move. Not this seminar. I'm going to give you real world examples of what I'm talking about. There are changes in the way stock prices move due to all the activity by exchange-traded funds. Now, there's some other contributors to that too, but by and large, it's computers managing money that's opened up a set of opportunities. Now, these opportunities are not as easy as opportunities have been in days gone by. I'll tell you that too, from the standpoint of activity level. But today, with the tools that you all have available to you, the tools that I have available to me, we can use those tools, and I think we can do very well. I think you can do very well if you learn how to use them. And there are a couple different ways of doing it. One of the ways we'll go into, something I've talked about my entire career, just following trends. That has been fundamentally changed by the exchange-traded funds. And these realizations, by the way, they come slowly over time, and they evolve relatively slowly. And some people are, never aware of it. In fact, I can tell you that some of the adjustments that Investors Business Daily has made, I know those guys are aware of it. Their adjustment, in my mind, is not the same adjustment that I'm making, but it's valid, and I get their point. Yeah, and if you wanted to do it that way, I understand. Also, they understand the psychology of the individual investors, so they've kind of catered to their wants and needs. Despite the fact, I think in the long run, it probably makes less money. Doesn't really matter as long as people are happy doing what they're doing, and they're making some money. That is awesome. But personally, I've got my own preferences, and that's one of the things I like to do. I like to tell you what my biases are and why, because everybody's got a right to an opinion. And I invest in a lot of things, by the way. So I'm kind of agnostic. I really don't believe when it comes to investing that there's one way and only one way. I've seen too many people be successful doing things that were actually the opposite of one another. They were really good at what they were doing. And so I actually like to use some of the old value investing, some of the stuff that Warren Buffett likes to do. That's very challenging. I like to do some of the trend following. We're going to talk about that at the seminar. These opportunities, they're very real. They're very real. And I think just having some light shed on them and some explanation is worth coming just to hear that, if you got nothing else out of it. Now, I use this material every day in my practice. We came up with a model because the Department of Labor was changing rules and guidelines. Now they've decided that they're not going to enforce them for a while. I don't really care. At some point in time, those rules are going to be law, and you're going to have to do these things. And there are good ways, and I think there are some inferior ways. And I like to try to concentrate on the good ways. I'd like to try to get the biggest bang for my buck, the most effective ways. And in many cases, this is the first time in the history of financial services that you can actually put together a portfolio that matches the categories in that Ibbotson material that you used to see. They called it the periodic table because it looked like a chemistry periodic table. But of all the asset classes, those guys sold that material for years and said, this is what you need to do. And the tools that were available to do it didn't match the categories that they had on your periodic table. So they're telling you to do something that you can't do. This is what you should be doing. And they didn't bother telling you, oh, by the way, there aren't products to fill all these categories. So you can't actually do what we told you. Now I've got one. Now you can. And that's just been within the past 5 or 6 years, incidentally. That did not exist until 5 or 6 years ago. Unless you are a multi-billion-dollar pension and you could afford to go out and hire Russell or Standard & Poor's to come out and put portfolios for you together for you. If you had a few $1 billion, you could get it done. And you had to have a few billion, by the way. A couple $100 million wouldn't do it. So today, that's changed. Now you can do it. Now an individual investor can do it on their own. So an individual investor can do things that only the biggest institutional investors were able to do 5 years ago. Think about that for a second. Now, the individual investor really doesn't have any idea of what I'm talking about right now and how good they actually have it. And there were a lot of good investments throughout those time periods, despite the fact that it didn't match what the quote unquote experts were telling you to do. And it would have worked had you been able to match their categories. It would have worked. You would have lagged by whatever your management fees were and whatever the style drift is. And there's some other things. There's slippage. Don't worry about any of that stuff. You'd have been able to come much closer to doing what they said you could do several years ago if these, decades ago, if these products had existed. They didn't exist then, and they exist now. And one of the reasons they exist, incidentally, is because there are a lot of pension funds out there that do have tens of millions who still can't afford to get the kind of stuff that they really need or couldn't afford to get it until these products were invented and introduced. And you can thank computers for all this stuff, by the way. Yeah, that's one of the developments that computers have added. They've really helped mankind in a lot of different ways. But the financial services, that's a pretty big one. It's pretty big. So being able to put together a really diversified portfolio that's got better diversification in it, much better than just a simple index, especially a market cap weighted index whose only criteria is market cap weighting. That's not the best way to invest, in my opinion. It leads to bubbles. It leads to very long periods where you've got zero or negative returns. If you live long enough, it's a good way to invest. If you've got 20 to 30 years, you could have overweight that in your portfolio. You could carry a lot of that. You could put most of your money in something like that. If you don't have at least 10 years before you're going to need to start tapping into that money, you shouldn't be doing that. Not a good idea. That's just not a good idea. So you decided to come to the seminar, I'll show you why. Decide to call me and set up an appointment, I'll show you why. I'll show you why it's not a good idea to do that. Despite the fact that it's got a great long-term return. It reminds me of I can't remember the name of the fund now, but the guy that owns the Boston Red Sox, he used to run it. He was one of the world's largest money managers. He quit doing that a long time ago. He got too big. He got so big, he was moving markets himself. Whenever they bought and sold, they were moving the market. The prices were changing. And but wouldn't you like to have that kind of money? I can go in here and I can disrupt all the financial markets around the world by myself. Not necessarily disrupt, but it actually becomes a handicap. And he knew it. He knew it. By the way, Moneyball, they had some guy play him, my mind is just going on me. Anyway, the guy had a really good long-term track record with this fund, but hardly anybody actually achieved the track record because it was so volatile that it would always scare them out. It was always scaring them out. You get a 70% decline, doesn't matter that it rebounds 450%. That 70% decline, pretty rough. You watch your investments drop by 70% and don't panic. Well, hey, I want to talk to you because I'd like to find out what you're eating. Because I need to get some of that too. The 70% drop that's a big drop. And then, but then to come ripping back and roaring back, he just decided that he was going to do it. I'll show you exactly what he did. Yeah, it'll take me 2 minutes to show you that. And but one of the reasons that he's one of the few is he would stick with it and wouldn't abandon it when things looked really bad because he knew what he knew. He knew that at some point in time, those prices were going to change, they were going to run, and he would recapture those losses and then some. And it worked out very well. Very well. Enough to buy a couple sports teams. That's not too bad. So what's really interesting is that today, anybody could do that if somebody would show them how. Anybody could do it. Back in the 80s, 90s, 70s, there were these guys, they were called trend followers. They were mostly proactive in commodities. A lot of them are still around. They just don't make the same kind of returns they did back then because the markets weren't as sophisticated and they were much more prone to making really big trend-like moves and then go back to chaos for a while. But those trend-like moves, capturing a big piece of a big move, was how they did it. It's the same sort of thing you can do today. You can do that. And individuals you've got an advantage. You're smaller. You can move faster. The technology now, one of my custodians allows you to put an order in and another order behind that one. So it literally changes. If this happens, this is going to happen. If this happens, then this happens. You couldn't do that, I don't know, the first 20 years I was in the industry. Nobody could do that. And now you can. So I think that's pretty neat. Is it easy? Well, psychologically, it's not. I can tell you intellectually, not too difficult. Not a lot that you have to learn. Psychologically is another story. We'll talk about that when we do the seminar as well. That's the hard part. The hard part of all investing is psychological. It's tough when the top 50 stocks out of all the stocks in the universe have done better than all the other stocks over the past 4 or 5 years, which is what has been the case. Because if you're not invested in those top 50 stocks, you're going, hey, what's up? Well, I got news for you. At some point in time, right now, those stocks are slightly ahead of where they should be. Those stocks are ahead of where they should be. So, and what's been happening recently is the other areas that have been lagging are starting to catch up. So the period of outperformance has been coming to a close. Some of the areas that had done very poorly relative to the top 50 stocks have really closed a lot of the gap, but there's still some time left, and we'll find out how to take advantage of that as soon as we come back from these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. All right, we were just talking about how to take advantage of some of the current opportunities. And before I continue with that, I would like to, again, if you go to my website, just remind you, to sign up for that seminar, the old seminar is still on the website, but if you click on register for this event, you'll be signing up for the new one. That's going to be January 18th. It's a corporate college over on the east side over there. Pretty close, pretty easy to get to, actually. It's on the near east side. And you can actually click on a map, and it'll show you right where it is. And that's going to be on the 18th, January 18th. It's a Thursday night, 6:30. There's no cost to attend. Feel free to call us if you have questions, too. And if you have questions, you can always go to my website and just click on the Contact Us, and feel free to reach out to us that way as well. And let's see, we're thinking how to take advantage of some of the opportunities. This is really interesting. It is really interesting. For the past 2-3 years, I've been trying to figure out why on earth are stocks doing what they're doing. And here's what I mean. Back in the old days, you get a stock that goes up 10 out of 13 days. And when it doesn't go up, it only goes down a little bit. That stock would have a pullback. It would drop back. There was actually a guy who wrote an entire book and even founded a consulting service based on that concept that was really popular. Well, today, that is less likely to happen. Let me put it that way. I look at this every day, more than once a day, and I'm here to tell you that stocks will run sometimes 14, 15, sometimes a month without taking a breather. It'll go up every day for a month. And that is unusual. That's not how it used to work. So how do you adjust to that? And of course, as soon as I buy it, it'll take that breather and it'll start coming down. So you got to be ready for that. You got to know how to handle that. What are you going to do? What's your strategy? And if you're not really able to think along those lines, because a lot of people aren't, a lot of people want to know what's going to happen in the future with a guarantee. And that's just not how the stock market works. Stock market's all probability. And it's all probabilities, not guarantees. What are the probabilities? And the probabilities, incidentally, you never get a probability of 80 or 90%. I shouldn't say never. It is incredibly rare that you get a probability of 80 or 90%. And when you do, what typically accompanies is a very small gain. And that's the problem with those types of strategies. When you're looking for a lot of high probability events, you're typically going to be looking for very small gains. And when you do that, inevitably, at some point in time, you're going to buy something or sell something short if that's what you're doing. And it's going to move against you in a large way. And so even though you were making money on 8 out of 10 trades, your account value ends up dropping because you're taking small profits and you get a large unexpected loss. And that's how that works. That's one of the reasons that a lot of people just give up on it. And I understand that. I understand giving up, getting frustrated. One of the other more sensible ways of investing, in my opinion, is you've got all these new tools out there. There are a lot of funds. They come out with 2, 3, 4, 5 a week sometimes. New funds. Find out which ones have the best risk-adjusted returns and use them. How simple is that? Now, if you don't have some pretty fancy software, it's going to cost you some money to buy the software because you got a few thousand funds out there now, and you're going to have to find some way to sort them, and doing it by hand, you'll never get to it. You'll never get through it all. So you've got to get some tools. If you're working with an advisor, you don't know if they're doing it, ask them what kind of tools they use. Ask them what their tools are. I use Morningstar. I've got a Bloomberg terminal. Got a service called Y Charts. So I'm kind of the belt and suspenders sort of dude. I like to try to cover all the bases. And they all have screening capability, and you can screen them by various metrics. So once you've got the list narrowed down, that's when the real effort starts to kick in. When you start to read about what they're actually doing with the money, that's going to be key. If you're a retiree, you probably want to be focusing on stocks that pay dividends or funds that invest in stocks with dividends. And I'm going to give you a secret here. Here's why. Dividend paying stocks tend to rebound faster than the average stock does. I didn't go back and back test. Well, actually, I have back tested this. I didn't go back and do the rigorous academic work that would win me a Nobel Prize because I didn't feel like it was necessary. When I run my models and I'm looking and I'm having the computer do the simulation, you can see and you can see why. You can look into it pretty in depth. But I'm never going to write a paper and submit it to the Nobel Prize Committee because they want much more detail, much more data. It's kind of like learning to drive a car. You don't have to know how to fix a car to be able to drive it, right? You just learn how to drive the car. The more you know about the car, great. If the car breaks down, you might have a chance or an opportunity to fix it without having to call to get it towed. That's awesome. But if all you really want to do is drive a car, you really don't need to know exactly how the car is made. On the other hand, with investing, you really want to know approximately what they're doing. And when you're a large company, a large investment management firm, and you have a lot of retirees that are investing with you, you want to probably make sure, and they know this, by the way, you're investing in stocks that pay dividends. And here's the basic reason is that when a good company goes down in price, when I say good company, I mean a company that's profitable, that's got sales. When a company's share price drops, its dividend yield goes up. So if it was a $50 stock with a $2 dividend, okay, that's 4%. If the $50 stock goes down to $30, they're still getting a $2 dividend. And I don't even know, 2 equals what percent of 30? It's like 6.66. That's a bad example. Let's say it goes down to 20. It goes down to $21. The $21. Okay, it's a 7% yield. So if I got a $50 stock that goes to $21, it was paying 4%. Now it's paying 7%. No, actually, I take that back. That's never mind. I should have worked on that before I started talking about it. But the yield goes up when the share price goes down because they don't cut the dividend because the share price drops. You know what amazes me? After all the years that I've been saying that, and all the years people have been living, I'll inevitably get some calls saying, well, they cut the dividend because the share price went down. No, they don't. They don't do that. They don't. That's one of the reasons that the dividend-paying stocks have a tendency, or have had a tendency, to rebound quicker. When your share price drops, the dividend yield goes up. If I paid $100 for something that was paying $5 in interest or in a dividend, and then it goes down to $50, which happens a lot in stocks. A lot of stocks will drop by half, no sweat. And it's only because the current psychological energy towards that company is negative, or people are perceiving that things are going to get negative, and they drive the share price down. They don't typically wait for that to happen, incidentally. They start to anticipate. So they drive the share price down. If the sales and the profits remain strong, they're not cutting the dividends, so that $5 dividend stays there. When the stock's at 50, that dividend now is 10%. Now, if and when whatever the perception was, maybe it was real, maybe not, maybe it was just a perception, maybe they thought something bad was going to happen and then it didn't, that day ever comes, that stock will take off like a rocket ship because it's paying a big dividend. Typically, when people pull money out of stocks, they pull money out of the stock market because most people are not holding individual stocks, they're holding funds. The vast majority of them decide to cut and go back to cash. They're going to sell all stocks. The stocks with the dividends and the stocks without the dividends. The stocks that have dividends, they become much more attractive much quicker than the stocks without dividends. So most of the models that I run have a large portion of the money invested in large dividend-paying stocks. And that's why. Because they tend to rebound quicker. How easy is that? Now, having said that, not all dividend-paying stock funds are the same. You still have to go in, you still have to read the management's discussion, try to get familiar with what they're doing, even if it's on a overview basis. You don't have to know exactly, but you should have a pretty decent idea of the basic strategy that the managers are using. That way you don't get surprised next time the market goes down. And in fact, if you're thinking about rebalancing your portfolio, say the market's down 25%, and you've had a good 20 to 25% of your money in short-term fixed income. Maybe you got 30 or 40% in short-term fixed income. That's a really good time to rebalance your portfolio. That's a great time to balance. Why? Because stocks are on sale. When you rebalance that portfolio, you're going to typically have percentages assigned to your account value for each of those categories. If you are nearing retirement age and you're overweighted in the dividend-paying stocks and you go in and rebalance a portfolio, guess what's going to get the most money? That's right, the dividend-paying stock funds, the ones that tend to rebound quicker. How beautiful is that? By the way, that's set up by design. You do not have to think about that. We don't have to think about that. When we rebalance the portfolio, the way that we've got it set up, it's going to do that automatically. You know why that's important? Because when you're emotionally upset to make tough decisions, or especially financial decisions, which are almost always tough, people generally have a tendency not to make really good decisions when they're under a lot of emotional stress. And when you see the value of your portfolio dropping, that's pretty stressful. So you have to have those decisions made before the event occurs. What are you going to do when this happens? Not, hey, we'll get, I'll think about it when I get there. And that's not a good idea. The better idea is say, hey, if this happens, this is what I'm going to do. Have a plan. It's not that hard. It's really not that hard for us. And we can build one that suits you. I don't think I have a plan. What's really funny is I often have to run a married couple's portfolio differently. This is why that I don't work by myself in my office. This is why we work with really big firms like Fidelity and Folio Institutional that have a lot of infrastructure to support us. Because when the time comes, we have to make those changes, and we have got to do them relatively quickly. And we can't afford to stop and have to think, or if it were a manual process where we're just going in one by one, trying to calculate the number of shares. No. We have software for all of that. We've already programmed in what your goals are, what your tolerances are, and it's going to go bring that up when we go to rebalance your portfolio. How cool is that? Man, somebody had told me I'd be doing this when I was a young man. I would have been, yeah, right. Not in my lifetime. Wrong. Man, was I wrong. But it's cool. I mean, I'm glad it's here. I didn't think it would get here this quickly. You can do all this stuff today. Let's see, mind-boggling. I didn't think that I used to spend hours waiting for the computer to get done generating the results for scans that now take about 15 seconds. Literally, 15 seconds. This used to take hours. I used to have to wait until 11 o'clock at night just to be able to gather the data, because that's how long it took the NASDAQ and the New York Stock Exchange and the American back in those days to get all the data ready for download. 11 o'clock. That's when I got to download. And by the way, it was so slow, it took nearly an hour. So at midnight, I got to turn my computer on, download the data, actually 11 o'clock, download the data, start doing the calculations, hoping that it wouldn't time out, because sometimes it downloaded so much data that the computer would actually freeze, because then I would go to bed and I'd get back up at 6 and run my scans. All of that can be done in about 15 seconds now. That just blows my mind. It is so much easier today than it used to be. Easier from a labor standpoint. The decision-making process is you're always going to struggle with that. Everybody does. Should I buy this stock? Should I sell that stock? Should I be adding, which funds should I be adding to right now? So far this year, the emerging markets index has been the leading category so far this year. Over the past week, it's down a lot. Not a little bit. It's down quite a bit. In 1 week, it was down 1.25% yesterday. And if you look at where it is, it's down 4% for the week. 4% for the week. But it's still ahead on a year-to-date basis. And when it's run up as far as it has, that's pretty normal. That's and by the way, those emerging markets funds, the ones that invest in them, they're going to be a little bit more volatile, because a lot of those companies are not as big as the companies in the United States. They don't have as much capitalization. It takes a lot more money to move our stocks by that amount. They will, by the way, because there is enough money to do that. But in the long run, the returns on a smaller, faster-growing companies has a tendency to be higher than the larger companies. Although, past 4 or 5 years, that has not, all the way up until this year, that has not been the case. And now, looks like some of that stuff is starting to come around. And this might be a good buying opportunity. And this is probably a really good opportunity for me to introduce the commercials that are about to come up. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned.
Out here in the field.
And we're back. Yeah, I forgot to give the phone number out today. Number is 216-901-0945 if you have any questions. And I'm going to do something that I've been promising for a long time. I've actually tried to do it a few times, and then I just, talk too much. You know me. And I never got around to doing it. But so we're going to talk about individual stocks, okay? Because I really like doing that. And before I do that, well, let me preface this by saying if you don't have a lot of time to spend on this, you probably shouldn't do it. If you want to minimize the amount of time that you spend doing this because you do like doing it, then you might want to get to the next seminar, or just call me at some point in time. You can come in and for a meeting. They're free. So, but if you really like it, I would try to get to the next seminar. It's never been quite as easy as it is today from getting the data. Now, the data, the scans that I'm doing, I have improved them over the last couple of years because, again, the market's changed a little bit. Actually, it's changed a lot. The number of new funds, it's been mind-boggling how many new funds have come out just in the last 2 years. And it's literally changed the way that stocks are behaving. There's an opportunity there. So that's what we're going to be talking about. And these scans that I'm talking about, whenever I say the word scan, so I'll give an example of what I'm looking for. This is one of my favorite scans. And the scan means I'm going into the stock market. I'm looking for companies who I think are most likely to go up sooner rather than later. And because being an investor means you have a super long time horizon, like 5 to 10 years as a minimum. As a shorter term, if you want to make more money in the short term, you're going to have to learn how to do trend following. And that's what I really like doing it. So I have the long-term investment money, by the way. I don't do this with more than 20% of my own money. So just take that for what it's worth. If I'm limiting it to 20% of my money, and I do this all the time, what do you think you should be doing? Now, if you're under the age of 40, don't worry about what I just said. Yeah, you can do this whole thing. If you're under the age of 40, the chances of you having enough time to do this are probably pretty remote unless you learn this really well. This is what I'm going to tell you. You look for stocks that have market capitalizations. That means the value of all the stock, if you add it together, is greater than 250 million. Now, I use 300 million, okay, because I like mine a little bit bigger. But 250 million is a minimum. And I'm going to reset that while I'm talking about this on the air. I just reset it, okay? And it increased the number of stocks that came up a little bit on the first scan. So I'm looking for stocks that are at least 250 million in value. That we call it capitalization. That's the value of the stock outstanding. Doesn't have anything to do with the debt or anything else, just the value of the stock. So I start with that, and then I rank all those stocks that are big enough, and quite frankly, those aren't really big enough. If you wanted to look at fewer stocks, you could move that up to 500 million, which is still relatively small when you compare it to the really big companies out there and the amount of money that's floating around looking for stocks to buy. The reason that that's important is that you want a stock to be big enough to gain the attraction of the institutional investors, because they're the ones that manage the trillions of dollars floating around out there. If they really like an idea, the company's got to be big enough for them to bother with or take an interest in, and you want to have that help there. That's what propels those stocks really high, is the ability to be owned by very large funds. And that's one of the key structural changes that's occurred over the past years. I remember looking for stocks that only had a $50 million market value. Now it's like 5 times that, and that's even too small. Realistically, it should probably be around 500 million. I keep mine at 300 million, but you can do whatever you want because this is America. So I set that scan to, first of all, show me the stocks that might get the interest of an institution, 250 million. I'm looking at the last 3 months' performance. I'm going to rank those stocks, and I'm going to look at just the top 10%. Just the top 10%. So in the last 3 months, I want the stocks in the top 10% as far as performance goes. So these companies are outperforming the other 90%, which is kind of a key. We'll talk about that more at the seminar. I also want to know that stock is still under accumulation. How do I know that? How do I know that a stock could still be under institutional accumulation? Well, it's pretty simple. If the stock is up 3% on the day, probably more buyers than sellers. I'm being facetious. But realistically, 3% one-day move is that's a pretty big move for a stock. So I have that set up in my screening criteria. I put a price-to-sales ratio on mine. That's something that we'll talk about at the seminar. I won't bother you with it now, but I have it set to less than 10. Now, I want the volume on that day to be higher than its average volume. The number of shares that are trading, I'm looking at the volume over the past 90 days, and I want the volume to be slightly higher than that. Why? Because you want more confirmation that this stock is under accumulation. And when the volume's increasing and the share price is going up, that means the buyers are being more aggressive than sellers are. The last part of it, and this will reduce your list count down to something very reasonable, is that the close for the daily price has to be up in the 25%, it has to be in the top 25% of that day's range. Now, when you put all those things together and you run that scan over all the stocks in the stock market, on Friday, you'd have gotten a total of 19 names. 19 names. So you've reduced over 6,000 stocks down to 19. Now, let me ask you a question. Would you rather look at 6,000 stocks or 19? Probably the 19. I'm just guessing. I don't know. Yeah, I know some people will probably look at all 6,000. Try to. So anyway, these companies are moving up right now and don't know how long they're going to go. And I'm looking at their value. Then I start to look in it, and I literally, from this list, I go down through the list, and I like to buy the ones that I like. Now, I do the same screen for stocks over a 1-month time period and over a 6-month time period. And then I put them all together in one list, and then I start going down through that list. But if I were forced to choose, and I were a home gamer, as the way Kramer likes to describe them, I would use the 3-month. If I only had a limited amount of time, I would only use the 3-month. What I like to see personally is that a stock has come up on all three. That's awesome. You get a stock coming up on all three, that thing is running. Anyway, so the first stock that comes up on that list today, or on Friday, was a company called California Resources Corporation. It's an oil and gas company located in, guess where? California. California has an awful lot of oil, by the way. An awful lot. Large portion of it's on government-owned land, too, and they don't actually release those statistics. Think about that for a second. Anyway, you look at the symbol on that one is CRC. It's the first one that came up on the list. Price-to-sales ratio is 0.33. I'll get it $17.45 on Friday. Closed right near the high. It looks like a cup and handle pattern where if you guys are William O'Neill followers out there, but the handle is lower than the 52-week high. But it's got a really nice trend to it. I looked up what they did. I read a little bit about the company, and I like it. I think it's probably a pretty good stock. The $17.45 is where it's at. In 2014, that stock sold for over $100. Think about that for a second. 2014, over $100, and it got all the way down to under right around $6. From 106 to 6. Now, that used to scare people. It used to scare me. What? Yeah, that's a big drop. Okay, so you've got to learn how to manage the risk. That part we will talk about at the seminar. How do you manage the risk on something like that? Because the chart looks great. Price-to-sales ratio is good. Oil prices have stabilized, quite frankly, and they keep trying to get a squeeze on. There are a lot of companies in the United States that with these higher oil prices now, they're not super high. If they go much higher, every dollar that they go up per barrel goes right to their profit line. So, and if something like this were to go against me, it would cost me 0.5%. Think about that for a second. 0.5%. I'll take that risk every day. It's only going to cost me 0.5%, but I can have up to 5% of my money in that one stock. So I'll let you do the math on that and figure that out yourself. Anyway, so the risk is 0.5%, but I have a 5% position on it. Okay. if I buy it. In fact, I think I just talked myself into buying that on Monday. I'll wait till 10 o'clock, by the way. And if it crashes on Monday, if it opens up like a whole lot lower because some smart aleck out there running a hedge fund heard my radio show or my podcast and decided to short the stock, I won't be buying it. So I'm letting you know up front. I'm telling you what I'll be doing. Anyway, that's got a classic looking chart pattern. When I say classic, if you've been around me for any length of time, you'll figure out what that is. Now, I've just been told I've got 1 minute left on the show. There are a bunch of other stocks there that, like I said, there were 19 in that one scan. Some of them look good. I would tell you, oil and gas stocks are running. They're doing very well. So if you're looking at a sector to try to play, exploration and production, you might find some ETFs out there. And I don't think I have enough time to look it up for you. I wish I did. And I will be able to do that in the future, by the way, because actually I can. First Trust AlphaDex ETF, FXN, holds that stock. So now that I hear the music, that means I got to go. If you've heard anything you'd like more information on, just go to my website to contact us. Other than that, have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.